Good afternoon, everyone, and thank you for tuning in today. I'm Julie Berry, and I'm a member of the Board of Directors with the CFA Society of San Francisco. It's my pleasure to welcome you to our event today, the new rules for growing wallet share. Our distinguished speaker today is Laura Gregg from FlexShares ETFs. A quick item just before we start, you will be muted for the event. So we encourage you to type your questions in the Q&A box. We'll monitor these closely and try to answer as many as we can. Now it's my pleasure to introduce Laura Gregg. She is Director of Practice Management and Advisor Research at FlexShares ETFs, managed by Northern Trust. She's focused on leading their proprietary advisor and investor research and building programs to help advisors and asset managers strengthen their businesses. She's a host of the Flexible Advisor podcast, where she speaks with advisors of all types and experts on a wide range of advisory topics. She speaks regularly at industry events, and her insights have been published in journals such as Forbes, Barron's, US News and World Report, Investment News, and CIO Magazine, just to name a few. She assists in guiding strategy for the Chicago chapter of Women Investment Professionals. She sits on the membership committee of the Money Management Institute and is a member of Women in ETFs. Laura's colleague, Joel Johnson, is also with us today. I'll turn it over to Joel to give some more details on his background and the FlexShares ETF platform before we kick off our fireside chat with Laura. Thanks, Joel.
Thanks, Julie. My name is Joel Johnson. I'm with Northern Trust. Northern Trust runs the ETF business, FlexShares. I've been in the Bay Area my entire life, working with advisors, the last 15 here in the Bay Area. Happy to bring this to you. I know that there's one thing that we can guarantee to our clients is that we will do our absolute best for them. And unfortunately, they don't always do their best for us. We want to grow wallet share with them. We want to build our business with them, but there are obstacles there. And that's what I most like about this program. Feel free to reach out in the question box if you have questions for the end, but we can also contact you after and set up a session to help you out with your challenges in this space. So I'll hand it back over to our speakers, and thanks again for your time.
Thanks, Joel, and thanks for helping out with the audience Q&A at the end here. So super interesting topic today, Laura. I'm personally really interested in this session. I'm always keen to learn more about behavioral finance. I know that the research that you've conducted is a little bit different since it's focused on asset consolidation among advisors rather than individual investor behavior. So can you provide us some background on the study?
Absolutely. And thanks for having me today, Julie, and for all the folks listening. So we started work on this about 2 years ago, maybe a little over 2 years ago. I run practice management, as you know, and all of the practice management that we do is proprietary, it's based in our proprietary research. So we invest a lot of money, a lot of interest in my time in doing these programs. So we started to hear from some of our client firms that they were having trouble aggregating client assets and asked if we could help them out. And we didn't have anything to provide at that point. So we kind of looked into it. And before we do any research of any kind, I always take a deep look at the industry to find out what's already there so that we're not duplicating what insights you all already have. And what we found is that there is very little on how to grow assets with existing clients. There's a whole lot out there on how to prospect, but really the focus, the most efficient way to grow clients, right, is to, or the most efficient way to raise assets is to grow your wallet share with your existing clients. And I apologize, I'm trying to advance my slide and it is not working. So we may not, there we go. Yes, so wallet share, it's a very enduring question, and it's not very well understood. So when we took this on, we hired a group that we've been working with for the last decade or so. These are PhDs. They've been trained at the University of Chicago, and they got really excited when they heard about this topic. For the last 20 years, the team has been working to understand how people relate to their money. They really dig deep on money stories of clients. So what we did, Julie, is we did 2 separate surveys of high net worth investors that were currently working with advisors. We started it off by conducting a qualitative survey, and what that meant is these PhDs, these psychologists, sat down with 35 high net worth individuals that were working with advisors. We asked them to dig deep on 3 things. One was trust. Why do some clients trust their advisors completely and others do not trust them at all? Transparency was the second thing that we really wanted to understand. Are clients truly being transparent with their advisors about how much assets they really have? And a spoiler alert here, they are not being transparent. But many advisors believe what they're told, and we'll get into more detail on that a little bit later. And then the third thing we wanted to understand, the third key thing, was how do your clients feel when you ask them for more money to manage? And how often can you ask that question of them? So again, started off with that qualitative research. They spent a minimum of an hour and sometimes more than 2 hours with 35 folks across the country, across the high net wealth spectrum. To be part of this, by the way, you had to have a minimum of $250,000 in investable assets. Most of the folks that we spoke to had way more than that. One woman had 30 million in investable assets, which of course excludes any qualified plans or primary residences. So after that first part of the survey was done, they came back to us and they were very excited about the findings, as were we. And they said, Laura, this is all you really need. This is statistically significant. And I said, but hey, there's only 35 people that you spoke to. They assured me that it was okay, it was good, but I didn't believe the PhDs. So we conducted an online survey where we got the input from, I think, 258 other individuals that were working with advisors. And lo and behold, I was wrong. The PhDs were right. Both of those surveys corroborated one another. A few key insights on how we conducted the survey, which I think is very important. We just spoke to, the asset levels we talked to, but we only spoke to those folks that were still in the wealth creation years of their careers. Secondly, and probably most importantly, the thing that took the most amount of time and cost the most for us was to get a diverse sample of insights from investors. It would have been very quick, easy, and quite frankly, cheap to tell you what men who are white in their mid-50s think about giving more or less assets to their advisors to manage. But we all know demographics are changing, and we all know wealth ownership trends are changing. So we're very proud of the diverse sample that we were able to get and to share these insights based on that diverse sample, which really kind of represents, fairly closely aligns with the US population. So that's kind of a little bit of background on why we did it, how we did it, who we worked with. And, if you have any other questions, let me know.
Yeah, that's really, really interesting. And I love the thoroughness of your research. And, like you said, we all read a lot about, prospecting ideas, retention of clients, and not so much about growing those existing advisory relationships. And you've talked a bit about this survey. Can you just spend some more time about the key findings that you had?
Yeah, absolutely. So again, our focus was on trust, transparency, and how do your clients feel when you ask them for more money to manage. And what we found is that, statistics are always helpful. I love statistics. I'm a researcher, right? But statistics about the market will not help you segment your current client base based on their emotions and the behaviors that are driving them to give you or not give you more money to manage. And, the little work that we could find that has been done in the industry really put all of the responsibility for getting wallet share on the advisor's shoulders. And so what do I mean by that? A lot of the information was statistical. So your clients will give you more money when they reach $350,000 in assets. Then they'll give you all their money to manage. Or if you had a better service model, then they'd give you more to manage. Or if you had better client events, or if you lowered your fees, and on and on and on. It always framed the issue as something that the advisor wasn't giving or wasn't doing. But what this research uncovered is that, one, of course, you're going to have good customer service. And of course, you're going to have a good lineup of products. That's table stakes. But that doesn't drive wallet share. What drives wallet share is the emotions of your clients, their money stories, how they grew up, how they saw their parents deal with money, their past experiences with financial advisors, their past experiences with our industry overall. Those are the behaviors that drive their decision about whether or not they will give you more money to manage. And until and unless you can understand what we call the black box of your clients' minds, it will be hard, if not impossible, to get all of their wallet share to manage. But once you can figure out who they are, you'll better be able to develop your relationship strategies and your communication strategies to speak to them, to help develop trust, a stronger relationship, and then ultimately get more of their assets to manage. And our work really, identified the behaviors that were driven by emotions, and it sorted very neatly into 5 different persona types.
Great. I'm excited to get into the meat of this. I was really intrigued when I was reading through it myself. Can you give us a rundown of these 5 personas and how they compare and contrast with each other?
Yeah, absolutely. So I'll start with the protector in yellow on the left. This is the most risk averse of all of the personas. These folks are desperately afraid of losing money. They're afraid of the market. They're afraid of our industry. They have a lack of trust of all of that. And unfortunately, they oftentimes have a lack of trust of the advisory teams that they hire to help manage their money. Now, these are the folks that will come to you, and if your minimum investment to start a relationship is $250,000 or $500,000, they will give you that and not $1 more. Now, that doesn't mean that they don't respect what you do, that they don't understand that they need a professional money manager. They absolutely do. It's just that they're scared to death that they'll lose all of their savings. And so what they are looking for is a relationship that they can start with the lowest possible risk and the lowest possible expense. These folks think that it is the wild, wild west out there, and that there really aren't rules. And if there are, that you may not follow those rules. Now, for each of our personas, we really did a deep dive with one of the folks that we talked to in that qualitative portion of the survey. And in our case study persona, protector persona, was a gentleman named Christopher, who actually lives in the Bay Area. He's 55. He's an entrepreneur. He has put all of his profits right back into his company his entire life. And recently he divorced and received a very large settlement and an inheritance. So for the first time in Chris's life, he's got about $5 million in cash, and he is terribly afraid to lose it. When we talked to Christopher, he said, he was still fielding calls from all the used car salesmen, which were not selling cars, but selling financial products. He went online when he heard he was going to come into this money. And so he's still getting calls that he asked for from advisors that would like to service him. It took him a while to figure out who he wanted to go with. He ultimately went with a very well-known brand name, thinking that if anybody could provide safety, at least that name might help. Now, when he talked to us about his advisory relationship, it sounded to me like they were really trying to do all the right things. They were trying to build that relationship with Christopher, inviting him to go to the Giants game. But Christopher just feels like they're trying to sell him. And he said, I have to sell for my business. I can't be fooled. I know they don't want me at that game because of my sparkling personality. They just think that I have more money and they want to get their hands on it. Again, he knows that he should be giving more of his money to be managed. He invested the absolute minimum, which was $250,000 of his $5 million. He's got the rest in cash. When we talked to him about whether he was transparent with his advisory team about all of his assets, he said, no, absolutely not, because then the sell job would just continue. And I hate that. And I do that and I can't be fooled. So he acknowledges that at some point he should give them more, but he is really waiting to make sure they truly have his best interest in mind and not just trying to make a quick buck off of him. So our next persona is the competitor, and investing to the competitor is a game, and it is a game that they intend to win. The competitor, you will recognize them. They are hyper-focused on performance. They will come to you, often tell you which benchmark they want you to compete against, how much they want you to outperform that benchmark. And every time you try to talk with the competitor about planning, they will quickly shift that conversation right back to performance. These are folks that really think they're a lot smarter than you. They often have a sleeve of the portfolio that they manage, or they have other advisors managing sleeves of the portfolio. And again, like the protector, not very transparent. Our case study competitor was a woman named Marg, who was also, like Christopher, an entrepreneur, a bit younger. She's 37 years old. And since high school, she's been dabbling in the markets and finally gave about 35% of her portfolio, which is about $1 million now, to an advisor. And she told us that the only reason she's doing that is because she didn't quite understand the Roth IRA and how it makes sense in her personal situation. But she assured us that as soon as she figured that out, which she didn't think would take much time, she would take those assets right back and manage everything on her own. Yet Marg and her competitor peers really tend to be a study in contradictions. They like to present themselves as cold-blooded business people that are smarter than anybody in the room, yet they're really looking for a relationship. Marg was very upset that this advisor, who she told us as soon as she figured this out, she was taking all the money back, but she was very annoyed that he wasn't doing anything to build a relationship with her. She said, if he wants my money for the long term, he'll have to show me his value. And so far, I'm not seeing that. And the next breath, it was, I'm going to take it all back. So these competitors are really challenging people to work with and for. The collector is our next persona, and the collector's guiding principle is just to spread it all out. They hate having all of their eggs in one basket. They love the idea of diversification, but to the collector, diversification is not just about diversifying securities within the investment portfolio. They want to diversify their slate of professional money managers. They don't understand that while they're diversifying across different financial advisors, that they're increasing risk and the risk of security overlap and all the other things that go with the lack of transparency. And like the competitor who was not transparent with her advisor, neither is the collector. Our classic collector was a woman named Karen. She is 65 years old. She's been working with 4 advisors for most of her adult life. One was her parents' advisory team, and others she's picked up along the way. When we talked to Karen, she told us she thought she'd retire at 65, but she has just about 900,000 in assets, and she really wanted to get over that $1 million mark before she retired. She also thought a few extra years would just do her well mentally. When we talked to Karen, she talked a lot about what she would do in retirement. And of course, she wants to travel, but she would also like to have the extra time to get things organized for her children. She told us what a pain it was when her parents passed and their estate was a mess. So in talking with Karen, we of course asked the logical question, would you consider reducing the number of advisors that you're working with, consolidating those assets and making it simpler for your children? And she said, no, absolutely not. I like each of the advisors. She's working with 4 of them. And I've been working with them for a long time, and maybe I'm ignorant. I know I'm stubborn, but this works for me right now. So we asked Karen about transparency, as we did with all of the personas. And she said, no, I don't let them know. I tried that once about 20 years ago, and it backfired on me. The advisor that I told that there was more money and more advisors, he got very greedy. And every single engagement with me, all he did was ask for more money. And I didn't like it. It made me feel icky. So as we pushed on that, I want to make things simple for my children and the consolidation thing, we asked Karen, what would it take for you to consider getting rid of 1 or 2 of your advisors? And she said, well, I would never just consolidate everything with one advisor, but maybe if one of them, and this really got to me, she said, maybe if one of them would focus more on me and less on my investment portfolio, then I might consider it. She went on to tell us that not one of the 4 advisors that she's worked with for decades had ever asked to meet her adult children. She didn't think that they even knew their names, never asked about her legacy, what she was planning for in retirement. None of them asked to do a financial plan. And what we think was happening there is that Karen did such a great job of spreading it out across 4 advisors that nobody saw her as a high value client. They saw her as somebody who was never going to have more money to add, and they B-listed her, and they gave her the minimum amount of service that they could give her to keep those assets. They were missing the boat. They could have gotten more assets if they tried to engage with her more. Now, our fourth persona is the verifier, and their mantra is to trust but verify. These are great clients to have. You most likely have a fair share in your current client base already. They want a consolidated solution. They want to get rid of the wealth management, get it off their shoulders, give it to somebody that they can trust so they can go out and enjoy life. These are great clients because they have some level of investment expertise, which is nice, but they will give you a decent amount of their portfolio to start the relationship. Generally, they'll give you over 50% of their portfolio to manage. So another great thing, but they are patient. They will wait before they move over all of their portfolio to you, or the lion's share of it to you, until you show them that you can deliver the client experience that they truly want. Now, our case study verifier was a man named Craig. And Craig and his wife about 8 years ago, Craig, by the way, is a mechanical engineer by trade. He's retired now, but he and his wife were looking for a wealth management team. And Craig's wife was hyper-focused on finding a good relationship fit. Craig, the engineer, said, hey, let's be honest, we've got 5 million. We're pleased that we have this, but at that level, everything is going to be automated. We have enough friends. We don't need any more. Let's just get some alpha and enjoy our life. Fortunately for Craig, they found a team who delivered on both, because a few years into that relationship, Craig's wife died unexpectedly. And of course, his world changed. So did his view of the financial advisory team. He was one of those folks that talked to us for about 2 hours. He was blown away that at his wife's funeral, nearly every member of that team showed up. He told us about a week or two later, one of the customer service associates showed up in his doorstep with a food basket. And he said, yeah, I know what you're thinking. That's not a big deal. You just go to a grocery store and you grab one of those. But when I looked at that food basket, I saw some of my wife's very favorite things. And I knew that that was curated, especially for me. He talked about things like this as the random acts of kindness that this team delivered in his darkest days. He used another example about a complex tax form that needed to be filled out. He's like, these people weren't my CPA. I've had a CPA for 20 years. CPA never came and told me about this tax form, but this team was on it. They ultimately worked directly with the CPA to get that done and take it off of his worry list. Craig said, I finally understand that this is about the relationship. My wife was right. I will never leave this team. So our last persona is the simplifier. These folks just want the easy button. They have no investment expertise, nor do they want it. What they want is to find an advisor that they like and that they trust will always have their best interest at heart. Now, these folks are easy to get. It can take 1 meeting, 2 meetings, a couple weeks for them to move all of their assets over to you, and they'll trust you. Our case study simplifier was a woman named Mayette. She was a Chicago police officer who retired during the pandemic with her husband, who was also on the CPD. I find it really strange. You know, I live in the Chicago area. You might have heard we've got a little bit of crime going on here. She was one of the most trusting of all the people we spoke with. We asked her how she got so comfortable. It took her 2 phone calls in 2 weeks to move $3 million, their entire life savings when they retired early, to go be with their daughter and grandchildren down south. And she said, I just liked her. She just made me feel good. She made me feel like she would be there for me. We asked her about her performance expectations and benchmarks, and she just laughed. And she said, look, I don't know anything about that. I just know when I see a number on a piece of paper, whether I'm comfortable with it. And I know when I talk to these folks, I'm comfortable with them. And I think it was the right move. Mayette also loved being a client of a very large, diversified financial services firm. She loved the fact that she got free wire transfers. If you're an independent person, no worries. The simplifier just wants you to be the quarterback of their financial life. They want you to bring things in. So that's a little bit about each of the personas. I'd love to, if you have any other specific question, I'd love to dive deeper.
Yeah, I think we're all mentally bucketing ourselves, our parents, our spouses, and certainly our clients as well as we listen to this and having some aha moments. They all seem very different from each other. And, as you mentioned, I think 3 of these 5 are not transparent about their total assets. So what advice would you give to advisors who want to understand whether there are more investable assets available in their clients' portfolios?
Yeah. So, well, I'll take the first 3 that are not transparent. The verifier, and I may not have mentioned it, they are very transparent. They'll tell you where the money is, as well as the simplifier. But, with the protector, again, it's the wild, wild west. They are just scared to death you're going to lose their life savings for them. So where you need to start, and I'll back up. We know that wallet share follows trust, but how you build trust with each of these personas is very, very different. And I think it's an easy mistake to make, right? Easy mistake to assume that the model for building trust is the same across your entire client base. And it's just not. So with the protector, for example, building trust, taking him to the Giants game out on the golf course, that's not going to work for the protector. It's going to fall flat. what will work with the protector is for you to be very clear that you do have his best or her best interest in mind, and that everything that you do doesn't necessarily benefit you financially. So how do you prove that? Can you consult a bit on the 401k assets that you're not managing? Can you take a call from his or her sister-in-law who's going through a very ugly divorce? Spend an hour of your time talking her through, giving her ideas on other resources, and not making the hard sell to get all of her assets after the divorce is final. They want to see that you truly want to build a relationship built on trust and not your financial gain. Now, with the competitor, how you build trust and the opportunity for more wallet share. And with each of these, by the way, they may not tell you, they may lie to you, quite frankly, or they may just, not offer up insights. So you need to just assume that there's more money out there that they're not telling you about. With the competitor, again, taking the competitor to the Giants game, I don't know, that might be okay. But what will really work with the competitor is telling them that you really, your intent is to not manage all of their assets. It is down the road. We know that, right? But in the beginning, tell them that. Look, hey, I'm assuming you're working with other advisors. I'm assuming you're probably managing some of this. And I respect that. I appreciate you joining, asking me to be on your team. I appreciate that. But what I really need, you have some very specific goals on delivering alpha. And what I need to do my job as your fiduciary and to deliver the type of return you're hoping for is transparency. So how can we get there? Another tactic to take with the competitor is to remember in the back of your mind that they think they're smarter than you. So playing the role of the advisor who knows more is going to fall flat with this person. Again, be on the same team. Talk to them about what's going on in the market. What are you thinking about inflation? What do you think, about this shift of control in Congress? Do you think it's going to affect the markets in any way? Whatever it is, ask them for your opinion, for their opinion, and have a peer-to-peer relationship with them. Through that, hopefully you can get to some more planning conversations. You can share, again, make the ask for transparency without, selling them hard. Now, the collector, again, a very different way to build trust. It's a bit of education again. The important thing for the collector to understand is that, again, you've got their best interest in mind, but educate them on what diversification really is. Educate them on the importance of transparency. The competitor will get that to a degree. It's their choice whether they want to give you the transparency. The collector, however, may not understand that by spreading it all out, they're really increasing their risk. And that, by giving them giving you transparency into what else is going on, you can do a better job for them. And again, the collector really does want to have a relationship with you. Ask them about their family. Make sure you know the names of their children and the significant people in their lives. It's not just about the investments with the collector. They really will lean into planning conversations. And all of these tactics, again, can grow trust and grow ultimately the relationship and then assets.
Very, very helpful suggestions. And appreciate the backup with the case studies. I think that's really interesting. And just, based on that, seems like the best clients to have are the verifiers and the simplifiers. So what can advisors do to grow assets with each of these groups?
Sure. So I've been talking about this now for a year and a month. We rolled it out in January of 22. And in the early days, I would say absolutely you should all prioritize the verifier and the simplifier. We've since conducted some advisor research, and I'll talk a little bit about that later. But these may or may not be the right people for you individually to focus on. But in terms of the verifier, how you can build that trust, and again, these are great clients to have because of their transparency and their investment knowledge. But the best way is to offer them the transparency that they're giving you in most cases. These are folks that will really appreciate it when you can identify the holes in their financial life. They're looking for that consolidated solution. They just want to be sure that you're covering all the bases for them. So when you have your meetings with them, make sure that you just bring it up. Of course, you're going to talk about the investment portfolio, but there's so much more than that the verifier is worried about. If ask them about their trust and estate documents, the beneficiaries, is everything in order there? What kind of mortgage structure do they have? Does it make sense? Whatever it is, they will appreciate if and when you can find the holes in their financial life. And they will most definitely lean into those planning conversations. And talk to them very candidly. Last year, I think this, and this went really great. I hope you do too. As we're looking forward in this new year, are there things that you wish I would have said, brought up, asked you that I didn't? I know that finding the right fit is really important to you, and I want to be that right fit. So let's work on this together. That'll go a long way. Now, with the simplifier, it's less about growing assets, because once you get a simplifier, you'll get all of their assets. However, retention is what you want to focus on with these simplifiers, because as nice and easy as it was to get all of their assets, you can lose them just as quickly if they think that you have not kept them front of mind. I really suggest that with your simplifier clients, you're talking to them on a quarterly basis. And, of course, touch on that investment portfolio. It's important. But what's most important to the simplifiers is understanding that you're thinking about them, that you want to know what's going on in their lives. These can be very quick calls. If they mention something, they want to take a trip to Spain, and you see something, in a publication about the 10 best restaurants in Spain or whatever, send that to them. That'll go a long way. Ask about their grandchildren. All of those things, those personal touches, will help you retain assets and remind them of all the things that are available to them by working with you. So if you're at a big firm and you can offer a free Amex card, let them know that, or free wire transfers, let them know that. If you're not in one of those firms, but you can bring together COIs to help them out, make sure they understand you can do that for them.
Wonderful. I just keep thinking about my mother when you talk about the simplifiers. It's so interesting. I think she's a poster child there.
Yeah.
But I think it goes to the fact of there's so many, each of these personas are so different from one another. What is the general rule of thumb for asking for more money?
Don't. Okay, so I'm joking there. But so, we probably all gone through sales training, right? And what I'm going to say now is just going to fly in the face of everything we learned. ABC, always be closing, always ask for the next money. Ask, ask, ask. The number of times you should ask your clients for more money to manage is exactly 1 time per year. Directly. That's okay. Everybody seems on board with that. They understand it. They understand, your business model. Asking more than that can jeopardize the relationship. It can end the relationship. But hopefully some of the insights that I gave, and we'll share more resources for you at the end of this, but that's those other things, those soft things that you can do to build trust by identifying the personas that you're working with that will bring more money to you.
Great advice. Now, in addition to your work with the individual investors, you've studied advisors too. Do you find that advisors prefer working with one persona over another?
Yes. So and we just completed our advisor survey, by the way. So this is kind of new to me, and it's really interesting. As I said before, I told everybody, focus on the verifier, prioritize there first. But what we found is that as maybe many of you were doing as we've been going through these personas, thinking, what am I? I'm the competitor, I'm the, whatever it is. We find that advisors prefer to work with personas that are similar to their own. So, in the early days, I was like, who would want to work with a competitor, right? They are tough. Well, competitor personalities like to work with competitors, and collector personalities like to work with collectors, and so on and so forth. But it's because we can understand them a little bit more because they're like us and we enjoy it. And a lot of the advisors that we spoke to in the advisor survey said, I like the challenge of the competitor. Others said they loved working with the protector because they like to educate, and it gave them great joy when they could educate a protector and ultimately get bring a protector to a simplifier status. Almost that was very rewarding. Now there are a lot of people that just simplifiers all day long, so it really is important for advisors to understand kind of who they are and who their ideal clients are. And we talk a lot about client segmentation. And I think most people probably segment by revenue, if not revenue, AUM, and that's great. And, I'm all for that. But what we suggest is, if you're segmenting by revenue, you've got 25 clients with high revenue or high revenue potential. Overlay these wallet share personas, prioritize them based on that. So out of the 25 people, are you a competitor? And, maybe you prioritize the competitors in that set first and focus there. Because at the end of the day, what brings us joy is what brings us success. So when you can work more with the people you enjoy working with, you're likely to have more success and gain more wallet share.
Wonderful. And enjoy your job more too.
Exactly.
Wonderful. Thanks, Laura. We're nearing the end here before we turn it over to Joel to help with audience Q&A. Anything else we should know?
Yes. Well, there's our disclosure. You should always know that. But the person you should know is Joel Johnson. He is new to my organization, but I am so delighted to have him. He is truly an advisor advocate. He wants to bring you great product solutions. But what I've learned about Joel in the few months that we've worked together is that he is truly committed to helping you grow your business. I guess I'm a little biased. I'm a practice management person, and I know that that's also important to Joel, but it's important to him in terms of building the relationship with the clients that he serves. So Joel is your guy. Please take his call. In the meantime, you can also visit a website that we've created. And on this website, you can watch some videos about the wallet share program. You can see we've done fun little videos on each of the personas. You can download a white paper. We have a fun little quiz, name that persona. We also, as Julie mentioned earlier, I host a podcast. And so, of course, we've done a couple episodes around this topic, but you can see a podcast there with the PhD that's way smarter than me. And he'll talk about the survey, how we did in the findings. So check that out, but absolutely, touch base with Joel. Oh, I'm sorry. I forgot the big reveal. We also offer workshops to groups of advisors. So if this is something that resonates with you and you'd like to learn more about, we offer 3-hour workshops if we can get groups of 8 or more. And I'll come in for a half day and we'll dig deep into how to identify those personas, how to get to the outcomes that you're looking through discovery and consultative questioning. And we've got, audio clips from the actual interviews that we conducted. And it's, we try to make it fun. And we've done 4 so far. We've gotten some good feedback. So if you'd like to learn more about that, again, Joel Johnson.
Excellent. Joel, do we have some questions?
We actually did. We had a few questions here.
Great.
The first one is for advisors who have been working with clients for a while and advisors who also are maybe a little bit newer. It says, how can we identify which persona a client is?
Yeah, well, so hopefully I gave you some ideas, but if you go and visit that website, you'll be able to download our white paper, which will give you some more insights. And if you really want to dig deep, visit us in a workshop. But just kind of think about those things. Is your client very scared to lose all their money? That's a protector. Does somebody come in and say, hey, I'm looking, I want to offload this. I just, let's work together for a little while, make sure we're a right fit. That's a verifier. And, again, more tips and tricks in those resources available to you online and through Joel. But this, by the way, we think it's really important in helping you increase client assets. We also think that a lot of this is very transferable to your prospecting. So I think you can use it in both. And as you're prospecting, again, think of that ideal client, where you can identify the personas that you work best with. Maybe you want to focus your efforts there as you, go through the discovery with the new folks.
One of the other questions was, do you have any advice for someone who is starting a new RIA? So we're talking just right at the beginning, anything that they should be doing.
Yeah. So congratulations. I wish you all of the best. That it's tough to start a new business, right? I don't know if you currently have clients that you've brought over, or if this is just brand new and it's ground up. So I guess the thing, and maybe I'm going to sound like a broken record by the end of this, but, again, to the extent that you can, where it makes sense financially, try to focus on bringing in those clients, your ideal persona, again, because you'll enjoy them. You'll be less likely to B-list them. You'll have more success in the long run. So if you're prospecting, use these same strategies in your prospecting. Also, we talk a lot about in this program about knowing when it's time to say goodbye. Sometimes, you might be somebody that just cannot muster the energy to serve a competitor and talk to them every month about how you did perform, how you performed over the benchmark or under the benchmark. It's important to understand those types of people that just aren't a good fit and to kind of identify milestones to exiting them. Now, some of them you can have discussions with and maybe get them more in tune to the service model you can provide. But if you can't, in the long run, it's probably best for everybody involved to know when to say goodbye.
And we have another question here, and this one's a bit longer, but it's related to having clients that are holding non-revenue generating assets. And the question is, if the client holds only non-revenue generating assets, how do you approach the decision to keep that client in your book? And part of that challenge is you have significant know your client AML responsibilities for reporting and record keeping, but they might be costing you more than ultimately they can make your firm. How should that best be approached within this framework?
So I would say, at the end of the day, we're in this to make money. We want to enjoy our job. We want to help people, but we do have to make money. Now, are these clients with non-revenue producing assets? Are there more assets out there that you can bring in that will generate revenue? Hopefully you can identify which persona that they fit into and approach, that trust building differently based on, the persona to try to get to that answer. And, it's okay to ask if there's more, if there's more out there. They may not be transparent about it. They may lie to you. But I think at the end of the day, after a certain amount of time, and that's for you to determine what's right. Again, if they hit these milestones where they're not adding revenue to your practice and they're not providing transparency about when that might come, then, you know, it may be time to figure out when to say goodbye.
Thank you. Yeah, that's all the questions that we have.
Excellent. Thanks for your help there. Since we have no other Q&A right now, I just want to say thank you to everybody for joining us this afternoon. I really want to say thank you to you, Laura and Joel. It's been a true pleasure. Very exciting topics here, and we're so excited you were able to join us.
Thank you for having me.
Thanks, everybody.